Today, we are helping people. We are saving people from making poor decisions on their home equity line of credit, choosing specifically the banks that some of you, many of you, have chosen in the past and did not realize a tremendous value of working with local credit unions in your state that you reside in. Over the last week, I've been going live consistently, going state by state, helping you find the right home equity line of credit. We're in a season now where we were going to start seeing interest rates starts to come down a little bit. In the last year, interest rates have gone down 1.5%, I believe, total. We just had a interest rate cut last week of 0.25%, and likely we will see another quarter point drop before the year is over, and we may continue to see that trend of interest rates going down at a slower pace than the last few years. We've seen interest rates rise at a very, very fast pace. With interest rates now coming down, how that affects borrowers is in a positive way, but can also be negative depending on which side you currently stand on financially. If you're someone that is trying to purchase a home in a declining interest rate environment, well, you'll likely see home values rise. So the other positive to that, though, is the cost to get that property on a higher valuation is easier than it was in a high interest rate environment. Now, for the vast majority of people that watch this channel, you're primarily focused on eliminating debt. You're not trying to finance anything right now. You're not trying to acquire anything, for the vast majority of you that are trying to get out of debt. And some of you have been watching this channel for quite some time, quite a few years, honestly, and you haven't actually implemented the strategy yet of velocity banking because the interest rates just didn't make sense at the time for you specifically. Maybe you were sitting on lower interest rate debts compared to other folks, and so it just didn't make sense. Now we're entering a season where in that time that you were paying down debt, maybe you had to get a new car and you financed it at 7, 8, 9%. Maybe you got a personal loan. Maybe you did some debt consolidation at 10 to 12% with Prosper, with Lending Tree, with Cabbage, one of these big institutions. Maybe in the last few years, you racked up quite a few credit card debt because maybe there was a job loss in your household, husband or wife, and you were leveraging 0% credit cards and you were kind of finessing, just balance transferring from one to another, and you find yourself in a lot of credit card debt. Interest rates expiring, they're about to jump to about 29, 30, 25 plus percent. And in that season, while you were racking up debt, while you were financing new things, making new purchases, you were also still paying your mortgage payment on time. And the value of your home has increased quite a bit, and you've made 24, 36 payments on your mortgage, and you've built some equity in there. You're now entering a season where these banks are becoming very competitive. They're rolling out new intro rates, new deals, new opportunities to leverage the equity in your home, to consolidate debt, to pay off debt faster, simply because you're going from a higher interest rate to a lower interest rate. And then what creates velocity is this ability where you're able to use all of your income to park into that new product that we're acquiring. So unlike a traditional consolidation where you just get a big loan with a fixed rate and a fixed payment, you get a line of credit that's revolving and it functions like a checking account. Some HELOCs, you're able to automatically deposit your entire paycheck directly into the line of credit, and you get sometimes a credit card or debit card, and you're able to use that to pay the vast majority of your expenses. And then the things that you're not able to run on a credit card, you're able to just simply transfer money through mobile banking, online portal, instantaneously back to the checking account that's at the same bank. So you're able to instantly access your paycheck, even though it 100% went toward debt pay down. You're creating velocity because you're allowing your dollars to be used twice. Your whole paycheck, 100% principal, goes into the line of credit. So you're effectively reducing your daily interest costs on what you owe. And when you look at a full year, if you're at a HELOC rate of 7.25% right now, and you look at the total amount of interest you pay in a year using this strategy, velocity, you may end up paying a net cost of interest percentage of around 4, 5%, some cases 2 or 3. The actual net cost. Your rate didn't change, but the total percentage amount of interest you paid was 2, 3, 4%. So you were able to cut your actual cost of borrowing in half. That becomes cash flow. That cash flow gets applied to the principal paydown of what you owe. And if you were already moving higher interest rate to lower interest rate, that's a win. We create velocity with the tool that we're using and the strategy of being able to park our paychecks instantaneously into that line of credit, use it again to finance expenses, cash flow stays 100% of the time throughout the month in the line of credit, effectively paying it down. So the way we're saving people is many of you come across this strategy on social media, Instagram, TikTok, YouTube, Facebook, wherever it is. And you're getting part of the strategy in the form of many different videos, in the form of many different voices. And some of us get really excited when we come across a new financial strategy that's promoting getting out of debt within 5 to 7 years, retiring early, debt freedom, leverage, credit, all this wonderful cash flow, all these terms get thrown at us, gets very exciting. Problem is, we don't factor in coaching, accountability, and support for the actual implementation of that strategy. So people watch a few videos, they get excited, they go to Bank of America, they go to Wells Fargo, they go to the bank they already bank at, get a home equity loan, or they get a home equity line of credit that's not structured right, and they find themselves not really getting the best results. Then they find out, once they do a little bit deeper of a dive in the material, then they find my channel or others that do deeper dives, then you get upset. You're like, oh my goodness, I totally did this wrong. I'm actually going reverse now. I'm going in the wrong direction compared to where I was wanting to end up at. So this whole series that I've been putting together is just analyzing each and every state in the United States. And we are going to the websites of these different banks, of these different credit unions. I'm giving you the action items, the things that you need to be aware of, the things that you need to have in place already for yourself, your financial position where you need it to be before you get the tool. Then you also are learning the strategy before you're getting the tool, setting yourself up financially. You get the tool, you're able to create acceleration immediately because you're getting products that are not being marketed anywhere. These banks are not spending a lot of money on marketing because they're putting their dollars in the product. Because these smaller banks cannot compete on the marketing scale side of things, like Bank of America, like Wells Fargo. These smaller banks do not have the marketing budgets that Wells Fargo, Chase, and Bank of America has. So Bank of America, these bigger banks, are acquiring the masses because of their marketing strategies and because there's literally a bank on every corner with these institutions. So the only way these smaller credit unions can compete today is by creating a better product. But nobody's going to know how great your product is if you don't have any marketing. So that's the pro and con to it. Now, the blessing is you have content creators today that will do the research, they do the investigative work, and they bring it to you for free. I'm an example of that. So this also encourages the customer to value doing business locally rather than doing business with institutions that just see you as an account number versus being able to do business with an institution that knows you by name. When you call, they're like, "Hey, Denzel, how are you?" They're able to see the phone number that you're calling from, and they're able to connect you. And there's like, "That's Denzel." Boom, the teller answers, "Good morning, Denzel. Good afternoon, Denzel. How are you? What can we do for you?" You're not going to get that service at big institutions. The other drawback, though, when you do business locally, is maybe they're not open 24/7. Maybe they don't have a customer service department 24/7. Maybe they close their banks a little bit earlier than other banks. So these pros and cons, in my opinion, the cons are irrelevant. Yes, it's a con, but to me it's irrelevant in 2025 because who honestly today is really walking inside of branches to cash their paychecks? Like everything is direct deposit, everything is mobile banking, everything is more digitized today that we really don't need to have those things. We don't really need to have an ATM that we can go to on every corner necessarily. And if we have to, we just make the plans accordingly, get it done, and you're fine. So as it pertains to this strategy, what matters most when it comes to velocity banking is the tool that we are using. If you have the wrong tool, you're forcing a great strategy with a dull knife, with a worn out screw. Like you're just creating extra work for yourself that's limiting the results versus having a phenomenal tool with limited financial literacy and knowledge can help balance the scales when you're first implementing this strategy. What's going to help offset your lack of knowledge, financial literacy, comprehension, strategy that we're all putting together is coaching and accountability. Being able to hire an expert to look into your finances in depth, and we're able to combine and make literal magic, in my opinion, financial magic, not numbers. There's no magic when it comes to the numbers, but I think the magic occurs when I'm able to work with a single mom of four who prior had very little financial knowledge information. I'm able to educate her on how money actually works, how the game is actually played, how banks make money, and how she can be an ally to the bank instead of a retail customer to the bank. How you can profit like the banks on a very small scale and not just be the profit machine of that institution. How you can be on the side of profitability and leverage all these tools and essentially just get a white glove service. So let's take a look at the board. Let's dive into this. We're looking at the state of New York, how to find the right home equity line of credit. Action items on the left-hand side of the board. As of 2025, September, prime is at 7.25%. Because it was announced mid-month, most banks will not adjust their rates until the following month. So by October 1st or sometime in October, everyone who already has a HELOC, you're going to see if you have a variable rate HELOC, you're going to see a 0.25% reduction. If it is a variable home equity line of credit that adjusts monthly. Some people have home equity lines of credits where it's variable, but the rate adjusts every 3 months, every quarter, or it adjusts every 6 months. I have a first lien HELOC that adjusts every 6 months. So I'm not going to see that 0.25% reduction next month. I think for me, I think it's going to happen around December, if I'm not mistaken, is when I'll see the next adjustment in my line of credit. Credit score, for the most part, this is my ideal framework. If you match this framework, all of it, you are going to get the best product. It's simple. So I stand by this. If you do all of this, you will get the best offers because the banks have told us what they want. And when we ask and then you verify, you're going to see the same results and be like, oh, okay, that's pretty cool. This is great. Here we go. Credit score, 720 or higher. The higher your credit score above 720, the better you are going to be called credit worthy with these smaller credit unions. The reason why you need to have such a high credit score with these smaller banks, again, Bank of America can take on people with 600, 650 credit score, low standard, because they're so massive, they're able to take on the risk of these what are called subprime borrowers, standard borrowers. These smaller banks are not able to take on that amount of risk. So they need better borrowers. On this channel, I'm teaching you how to be a better borrower, where you actually profit in your time of being in debt. And when you are finally debt free, you're not just debt free and never touching debt again. You actually have authority, knowledge, and wisdom over your debt. You now know how to use debt as capital as leverage to create cash flow, and you borrowed tax-free capital because debt is tax-free. And then there's tax strategy that comes with it long term, depending on what assets you accumulate and what financial vehicles you use to create that cash flow, which could also in time become tax-free. So it is a different game that's being played, and you're learning it firsthand. So credit score, 720 or higher. DTI, debt to income ratio, 30% or less is perfect. You do not want to exceed 45%. Preferably, banks really don't want to see you above 37, 38% on average. When you get to 40 and up, it's more risk. The more DTI you have, the less likely on paper you can afford to owe the amount of money that you're applying for in credit line. That's how they view that. LTV options, loan to value, 70 to 90% is where most banks fall. There are some that go as high as 95 to 100%. Typically, the higher the LTV, the higher your interest rate will be. The lower the LTV, in some cases, the lower your interest rate will be. So preferably, I like to see you have a significant amount of equity in your home because I don't necessarily want to borrow all of the equity in your home and create all that leverage and risk. I want to be at that 70 to 90 or less, because typically that's where we're going to get the best deals with these credit unions, as you will see when we get to the right-hand side of the board. Closing costs, I want to see zero, preferably zero closing costs, because we're specifically focusing on a second position home equity line of credit, which means you're still going to have your first lien mortgage. When it comes to first lien HELOCs, very rare will you see no closing costs. Those do cost money, and they're typically, it's like closing on a brand new home again. So you're going to have third-party fees more than likely. And with the bank itself, they'll have their own costs associated with it. But when it comes to second lien HELOCs, they often will waive their closing costs and even credit you third-party costs and fees with the state that you're in. So zero or low closing costs. To me, low is 500 or less. When you start getting 500 up to 1,000 or more, that's where it's pretty costly. We have to factor in whether that fee is worth it compared to what it is you're trying to do. Intro rates are back. They're stronger than ever. They're as strong as they were back in COVID, early years of COVID. I'm seeing intro rate promos as low as 0% today. So that's very attractive. 6 to 12 months is the typical range that you'll see, ranging anywhere from 1.99 to 5.99%. And in some rare cases, you're going to see fixed home equity lines of credits where you can get a fixed rate for about just under 6%, between like 6 and 7, 5.25 is the lowest I have seen so far. Anywhere from 3 to 5 years. That's very attractive. If prime is at 7.25 and you're at 5.25, you're 2 points below prime. It's going to take a while before we see prime come down to 5.25%. The Fed would have to cut rates 2 percentage points. On a global economic scale, I don't like that. I don't want to see rates go that low, because we could see we could see more borrowing at, like we saw in the last decade. And because of COVID, we have seen the increased amount of money printing, which has essentially created this buffer where we are still in a financial bubble. We're still in a lot of fake success, fake money. And it's just a matter of time before that eventually blows up. By keeping us at a higher interest rate environment, what's happening is, and it's happened over the last few years, fake money and fake success has been getting exposed quite a bit. Lending has tightened up. It's a good thing, in my opinion, that lending gets tightened up, that fake success gets exposed, so that people who have been putting in the time, people who have been putting in the work, are now going to get exposed. The real leaders are now getting exposed in 2025, 2024, last few years, coming out of COVID. We're seeing the real leaders get exposed in the business world, in the political world, you name it, in all the different industries. The real leaders are getting exposed, and the folks that have taken advantage, mismanaged funds, are getting exposed in a negative way for those who have been abusing the system, so to speak. But those who have not been abusing the system, you're about to be rewarded dramatically. Your valuation in your company is about to increase. Your economic value, your impact is going to increase, and we will see the squeeze with certain industries if we stay at these rates. So I'm actually a fan of staying at a relatively higher interest rate environment than to go back down to zero, because that just doesn't make sense financially for the economy. I think it allows us to not necessarily experience a full-on recession, but we're going to experience people failing, businesses failing, because they were borrowing at 0% or leveraging debt at massive amounts. And now that revenue is not coming in because why? Well, when interest rates are high, cost of living is high and expenses are high, and people are just not going to be spending like that anymore. So in a higher interest rate environment, to me, what I see is people have to become better stewards of their money, period. They have to become better stewards. So I'm a fan of seeing the vast majority of people become better stewards of their money and not be in a position where they have to borrow. I want you to be in a position where borrowing is a feature and benefit of your overall financial strategy, but you're not dependent on it. Okay? So that's always going to be my position financially. Is I want to see you be better stewards, better borrowers. Leverage when necessary. When it's not necessary, you know how to turn it off. You don't become dependent on these things. Coming back to our action items list, we covered credit score, DTI, LTV, closing costs, interest rate calculation. You have three options. You're either going to have a home equity line of credit that's based off prime, prime minus, or prime plus. We want to be in prime minus or prime. If you're at a prime plus, you're always going to be paying extra because you skipped step number one. If you overlook your credit score before applying, if you don't know your credit score before applying, then you will likely end up here at a prime plus. You will pay for it. So your ignorance will cost you thousands of dollars in interest alone if you choose to continue to ignore this. Your credit score will cost you thousands of dollars in your lifetime if you continue to ignore your credit score. You have to know where you stand when it comes to your credit score. It's like knowing how much money you have in your checking account. Knowing what your credit score is like knowing how much you have in your checking account right now. You know if you can buy this or if you can't. Okay? So the higher your credit score and the lower your DTI is, the more likely it is you will be at a prime or prime minus. That's huge. Draw period, 10 years. Some go as high as 20. The norm is 10. The lowest is usually 5 years. Depending on how good the offer is, I'll take that 5-year draw. You want to build a relationship with the bank, become a member, sign up, open up a checking and savings, move your paychecks over, set up direct deposit, move your active income money, not necessarily your, if you have money in a high yield savings and you're getting a good rate, okay, keep that money there. If you're not, and we find another bank that's giving you better interest rates, consider switching. I always say this, people, you are not married to these banks. You married your wife. You married your husband. Stay married to them. When it comes to banks, you're not in a marriage. You can leave at any time. I know it can be a slight headache, but it's way less convenient. It's way less, what do I want to say? It's not as hard to switch banks as it is to get a divorce. Like that's the comparison I was trying to make. You know, it's way harder to go through a divorce, splitting bank accounts, right? Splitting the money and settling things with the lawyer. It's a mess. Even in a cooperative separation divorce, it's a mess still. But moving from Bank of America to a local credit union in your state is peanuts compared to that. So let's not get bent out of shape if you've had a 25-year relationship with Wells Fargo or Bank of America. And let me also bring to your attention, because I know the vast majority of people that watch this channel are minorities, blacks and Hispanics. So, hey, black people, hey, Spanish people, wake the heck up. When it comes to banking with these major institutions, are you blind to the fact that they've committed uh, discrimination and abuse at the levels of which you've never seen before when it comes to manipulating interest rates for black households, Spanish households? I mean, the facts are out there. Just research it. Look how many fines Wells Fargo has paid over the years. I'm astonished every time I see a black family that does business with Wells Fargo. I'm astonished. I'm like, are you kidding me? Spanish people too. I'm like, really? Wells Fargo? You're still doing business with them after what they did to you. Oh, you don't know. Got you. Look up the facts. Look it up. Look how many fines they've paid. Look how many lawsuits. Look how many settlements they've had over the years. And you've got this non-for-profit bank, maybe 3 miles, 5 miles from your house. Maybe it's an extra 5-10 minute drive. It's not around the corner like Wells Fargo is, but it's 5-10 minutes out. And it's a non-for-profit bank that gives money to the black community, gives money to the Spanish community, gives money to certain organizations and nonprofits. It's time to wake up when it comes to where am I parking my money? Who am I voluntarily doing business with on a day-to-day basis that they do nothing for me or for my demographic, for my household? It's time to wake up. From that perspective, right? That's an emotional perspective for sure. There's some math behind it where I'm like, hey, you literally could net more of your paycheck each and every month by doing business with these smaller banks if you were to just wake up. But the problem is we like convenience. We like convenience. That's what it is. Continuing on, mobile banking is key, which increases velocity. If you go with a credit union that's so outdated and they don't have a mobile app, and they don't have a way to transfer money instantaneously from a checking account to a HELOC to checking, that's actually a deal breaker for me. No matter how good the offer is, for me it's a deal breaker because I know I can find a better bank. I know I can find a better bank. Lastly is payment calculation. This is just a reminder to read between the lines. I have had people apply for home equity lines of credits thinking it was a home equity line of credit. They sign and it clearly said home equity loan. Disclosures, home equity product, home equity loan product. And you have to understand that as we're playing this game, this cash flow game, this game of Monopoly in real life, you have to understand that there are some players in this game of money that are not going to teach you anything. They're going to sell you what benefits them. And if you're asking for something, they may even play a finesse move on you and give you a totally different product because home equity loan and home equity line are used interchangeably with the banks. Oftentimes, in some cases, the person you're speaking to over the phone doesn't even know the difference in some cases. In fact, many of them get training to encourage you to get the home equity loan over the home equity line because sometimes the home equity loan is a lower interest rate than the home equity line of credit. So they will push you, they're trained to push you toward home equity loan because it's less riskier for the bank. It's a draw of money initially, fixed payment, fixed rate over time. Versus when it's revolving, the bank has to have that money there and available for you at all times because you're going to put the money in, you're going to take it out. You're going to put the money in, you're going to take it out. So you have that constant flow of money. So when it comes to payment calculation, you need to know this key word is revolving in the terms. Like just making sure it's a home equity line of credit's revolving. I have a draw period, 10 years, 15, 20, 5 years, whatever it is. And then you're going to be left with two options. Either you're going to have a HELOC that is interest only or principal and interest payments. Interest only or principal and interest payments. Typically, if you have a principal and interest home equity line of credit, you will often see a lower interest rate on the intro and on the overall variable rate. When it comes to interest only HELOCs, you'll sometimes see a higher interest rate. If there is no difference with that specific bank, I typically will just go with the interest only. I like principal and interest payments simply because it enforces the pay down of the line before the draw period is over. It enforces that. So that's important to me, honestly. So now we got 1, 2, 3, 4, 5, 6 banks that I've personally researched for you in advance. We're going to go through them thoroughly. We're going to go to their websites and we're going to read together. I'm going to see these different products. We'll go through it, and then I'm going to give you my favorite picks based on the information that I'm being given by the bank's website. What you don't want to do is see the banks that I've laid here and just pick any one of them just because it made it on Denzel's whiteboard. You don't want to do that. You also don't want to just go off what I'm preferring. If it were me, once I give you my top 2 picks with these banks, you don't want to just rely on that. You want to trust me, but verify the information for yourself. There's nothing wrong with trusting me. The problem is when you blindly trust people. Sure, I trust you, Denzel, but I'm going to verify. I'm going to call Municipal Credit Union and verify that that promo rate is still active. What if it changed? What if it changes next month? So what will remain evergreen with this content, whether you're watching it live with me right now, or if you're watching it 5 years from now, what will remain relevant is the left-hand side of the board. That's going to remain relevant. Banks come and go. Offers come and go. But if you have your framework, you can't go wrong. Because again, you're not married to these banks. You use them for the products and the offers and the incentives that they give. And when the incentives go away and the offers go away, it's like shopping for car insurance, homeowners insurance, healthcare insurance. It's like once they start charging too much and another competitor comes and says, hey, we'll charge you less and give you the same amount of coverage, guess what? It's a financial decision. You're going to move. You're going to switch. Unless you have loyalty to the agent that sold you the policy. That's different. I understand that. When it comes to banks, there's no person getting necessarily a commission that you and I know of, or even if you have a relationship with a family member that works at a bank, they're getting a paycheck. They're not working 1099. They're getting a paycheck no matter what. So be open to moving when the offers go away. Be open. Because it's just going to help you get out of debt faster. It's going to help you manage your cash flow more efficiently. Okay. So the banks we're going to be looking at: Municipal Credit Union, Broadview Federal Credit Union, Hudson Valley, Hovia, Advantage, First New York. These are the banks we're going to be looking at. These are the key details that I pulled off of each site. There's some information that I don't know. I'll make that clear. And we'll have some fun. Let's dive into it. So the first bank, Municipal Credit Union. This is what it looks like. I'm already on their rates page. We come over to home equity loans. See how it gets used interchangeably? Home equity loan. A home equity line is a home equity loan, but there is a difference between the two. Here we have home equity line of credit rates. And then if you keep scrolling, Here we have home equity loan rates. Now, this bank specifically offers a first lien product and a second lien product. We're focused on second lien right now. Okay, I'll have a whole series on first lien HELOCs as well. So here we have three different options. We've got a home equity line of credit first lien promotion, 5.49% for 12 months, as low as 8.75% afterwards. So that is a prime plus 1.5% margin. Typically with first lien HELOCs, that's a bit of the norm to see a prime plus a margin on a first lien because of the additional amount of leverage that the bank has to carry. It's a larger line of credit. You're actually financing the entire home, right? Because you're replacing your 30-year mortgage or you're buying a home with a first lien. So that's why they typically have these additional margins. Now, with some banks, you also can purchase the margin rate down in quarter point increments or half a point increments, typically. Focusing on the second lien HELOC promotion, 5.99 for 12 months, as low as 8.75. So notice how no difference in that prime plus margin rating. So I don't love that. The 5.99 is cool though. 5.99 for 12 months is cool, but is it worth it? To be at a 1.5% plus margin in this current environment, that's high. That's high. Then they have this other introductory rate. If I'm assuming their promotional range. So again, based on your credit worthiness, either you're going to get as low as 5.99, maybe as high as 6.875. Minimum lines 25. They do go as high as 500K. That's not horrible. As you can see, 80% is our LTV, right? And this I don't love either, an immediate draw of $25,000 required at closing. Don't love that. Many times they want us to keep a certain amount owed. So 12-month period, immediately following the annual applied to blah, blah, blah. Subsequently, your account will be subject. Okay. Let's keep reading. For 100,000, 25. So the higher the credit line, the higher the draw. Don't love that at all. So that's a deal breaker for me. As good as the intro rate was, it's a deal breaker. They want too much. They're taking too much, right? They want prime plus 1.5%. They want me to draw anywhere from 25 to 100,000 bucks. They're asking for too much. Don't love it. Now, what is pretty attractive, and the reason why I wanted to show you this, is the max that the rate could go up on this product is only 11.5%. The floor cap is 3%. Closing costs are waived if you take a minimum advance of the $25,000 and keep your line of credit open for at least 3 years. Otherwise, you'd be required to reimburse. Blah, blah, blah. These fees can be as low as $135 for a $25,000 HELOC. Nothing, too crazy there. But the max rate that you'd get charged is 11.5%. I'm not upset about that, but it's still a deal breaker. The other things that they want from me, it's just a little too much in my opinion. So let's move on to the next bank. Now, in some of my previous live streams, we've looked at this bank specifically, Broadview Federal Credit Union, because they cover multiple states If I'm not mistaken, it might tell us. Where is it? I think this state is in Pennsylvania when we did that. So they also cover New York as well, and that's what we're focusing on. So look how much more attractive this is right off the bat. 0 closing costs. 3.99% for 12 months. That's better than 5.99. Goes to 7% afterwards. So that's prime minus 0.25%. It's pretty attractive. Interest only payments. Here's where it gets even more fun. They have a fixed 5.25% HELOC and a 5-year draw. So the rate is fixed for 10 years at 5.25%. That's extremely attractive in 2025. Specifically, hear my words in context. Don't take it out of context. This is extremely attractive in 2025. 5.25%. You're 2 points below prime today, and you stay that way. By the time prime ever gets there, if it does, you've already done the damage that you needed to do. 90% LTV, the credit line's not as big, 250,000. But that's usually not an issue. Credit line max amounts are usually not a big issue in the velocity world because we're doing things in chunks. We're paying things off in chunks, and that also reduces our leverage when borrowing. Okay. So Broadview, very attractive bank. Let's move on to Hudson Valley. Hudson Valley. Here's another reason why this bank made it to the whiteboard. No closing costs whatsoever. We like that. They have a home equity line of credit, fixed rate, fixed intro rate for 6 months at 4.5%, and then it goes to prime afterwards. That's pretty solid. No argument there. No closing costs. We like that. There's an additional detail that makes it even more attractive, and that's this right here. Save even more with our auto pay discount. So they're basically telling us to do velocity banking without telling us. They're like, hey, if you bank with us fully, open up a checking account with us, have your paychecks come here, make your payment to your HELOC here, and we're going to cut 0.25% off. So you'll be at a 7% interest rate. You'll always be below prime by 0.25%. That's attractive. Okay? That's pretty attractive. We like that. I always like to look at these little sentences, paragraphs at the bottom here, see if I can get any more additional context as to what I'm looking at. That just verifies the 0.25, right? Automatically transferred, not bad. This is also talking about like a solar thing. We're kind of skipping that right now. Notice how the max is 18%. Honestly, I really don't pay much attention to that because I don't see a world where we go that high. If we go that high, we're going to have other problems to worry about. And by then, especially in this time and place that I'm serving you all in, the goal is not to stay in velocity banking territory your whole life. The goal is to create velocity. So when you are entering the highway and you're on that ramp to get onto the highway, you have to accelerate the vehicle to begin to match with the speed of the other cars that are already on the highway. So you're going to increase velocity, right? You're going to accelerate your vehicle to get onto the highway to merge on with other fast-moving vehicles. Okay? Now, the reason why we take highways to get where we want to go is because it saves time, goes faster. Once we've approached our destination, what do? We start to decelerate, right? Start to slow down to get off, merge onto the ramp to get off the highway to reach our destination. We don't always want to be in this high speed of velocity. Sometimes it can cloud our vision and clarity in terms of what we're actually wanting to do with our finances. So we don't want to get stuck in this flow of leverage. What can happen, and I've seen this before happen, so many people that don't get coaching, that don't hire a professional, they don't know when to stop. Sometimes this can feel like a little sugar rush for you. It's a little bit of a craving. You're like, ooh. And then this mentality gets transferred onto credit card usage and abuse. It's like a sugar rush. It's like, ooh, 0% offer, 0% offer, 0% offer. Right, you guys get a little weird. I'm like, whoa, mom, relax. Dad, what are we doing? Not everything has to, 0%, 0% for 15 cards. Now, if you're a good steward and you're disciplined, I got no problem with you. I have clients who have 30, 40, 50, 60 credit cards. They manage it beautifully. They're in their own world. They love it. They're travel hacking. They're getting points, miles, cash back, you name it. I personally have about 18 credit cards. I manage them. It's not much for me. For someone else, that can be extremely overwhelming. So again, as a professional, I meet you where you're at. My goal is to build you up, to get you to your vision. We need to know what your vision is. And you need to understand that we're not always going to be going 100 miles an hour. We have to know when to get off the highway so we don't miss our exit. If you stay on the highway forever, guess what? You're going to run out of gas. In this world, for velocity, that means ending up in a higher interest rate. You're basically on the HOV lane, you're on the toll lane, and you're just paying exorbitant fees. And there's no traffic on the free lanes. You're just on the toll lane, and there's traffic, and there's like you're paying all these costs and fees, and it's annoying. So you don't want to stay there. Okay, very, very important. Don't want to stay there. Let's continue. Hopefully these analogies and stories are helping you out. So moving on, we got another bank. I haven't put it on the board yet. I was just looking through these different banks. So this was Hudson Valley. So this is called Suffolk Credit Union. And this is just me doing additional. I think what like threw me off was this 6.74% for 15 months. I was like, whoa, let's see what that costs. That sounds attractive. They might be teasing me with that. We'll cover the closing costs except for the appraisal fee. 500K max. As low as 8.5%. So that's prime plus 1.25%. But the 6.74 for 15 months, pretty interesting. Is it worth it? Then they have this 0.25% discount for auto pay. Not upset about that. The introductory rate will range from 6.74 to 9.74. It's like that doesn't even make sense. Just put me at the regular rate at that point. Lines up to 100K require 15K minimal advance. 35K between 100 and 250. You see how much they're asking for? They're like, sure, we're going to dangle this carrot in front of you, 6.74, 15 months. but you got to withdraw a lot of money, and you know, I may not love that. Now, what is pretty attractive where someone would want to work with this bank is the fact that they do lend up to 1.5 million on a home equity line of credit. So that might be attractive depending on what we're doing. That's when we get into the world of leveraging to create more cash flow. That's where it just becomes a different conversation. The lens that I'm looking through is relevant to the vast majority of you watching. We're looking through a lens of how do I pay the least amount of cost to get out of debt, to eliminate debt. So that's the lens that I'm currently looking through for you, because I know the vast majority are looking through that lens as well. So the only reason why I'm not putting Suffolk on the whiteboard is compared to the other offers. It just doesn't make sense. Throw it on there. But I figured I'd share with you anyway my research. Understand the banks that I'm finding is based on my geographical location. So if I was actually in the state of New York, more banks would pop up for me. So understand that when you do research, you might find different banks and you might be able to beat what I find on my whiteboard. So keep that in mind. Keep that in mind. Here we have another bank, Visions Federal Credit Union. This was another bank we covered. They don't have too much information, but we do know no closing costs. They have a special HELOC offer. Let's go to view rates. Prime minus 0.25, that's always attractive. Not upset about that. I don't see a intro rate, but Visions could be another one. 100% LTV, not horrible. Let's see if they show. Oh no, they don't show anything there. Let's see. Okay, it just takes me back there. Yep. That was just another bank, another research. Hovia. This did make it to the whiteboard. I'll share with you why. So, another 5.99, similar to municipal for 12 months. They do 1.5 million max. These are the different HELOC product options. For the person that's trying to accelerate debt, you're looking through the lens of no closing costs, least amount of money. We typically won't need that much in credit line. So they do 25 to 500K, 80% LTV, 5.9, 12 months, prime, 10-year draw, no closing costs. We like that. That's attractive. That is more attractive than municipal. Okay. See if there's anything else we can learn. You don't want to get confused when you go to actually talk to the bank, just because they're like, you can borrow up to 100%. Like, yes, but then it comes at what? A cost. Remember how I said earlier, the higher the LTV, typically the higher the cost to borrow. So don't get confused with that, with the product options. This is a high LTV option. This is a no closing cost option. You want the no closing cost option for the vast majority of you watching. There's also no intro offer on the high LTV option. So you want to make sure you're applying for the right product. That's also very important. Some of you make that mistake, man. Little mistakes. You're like, boom, give me the high LTV one. no intro. You're like, wait, I thought I was getting an intro. Now I'm Prime Plus. Now I'm at 8.75%. Denzel, what'd I do wrong? Well, number one, you didn't hire me before you applied. So many of you are so afraid to invest in yourselves that you become cheap for yourself. You're not willing to invest a few $100s or even a few $1,000s for long-term financial coaching. You think that's expensive to pay a few $100s to a person, a financial professional, or a few $1,000s for long-term coaching. You think that's expensive. What's more expensive is this mistake right here, this 1.5% mistake. The fact that I just saved thousands of people this decision right here, that this video will get watched God knows how much over the next God knows how many years. That right there is thousands of dollars in savings. Because so many people make that mistake. They think they need a large line. So many of you do not. You don't need a large line of credit. Many of you just need about up 50K, 75, 100,000, 150. Just because you have 300,000 of equity doesn't mean we get all of it. Again, if it has no impact to the cost and rate, then fine, we'll get it. But if it's going to cost me, then I'm going to stay below the parameters that the bank is setting. So key, so important. Next bank, Advantage Federal Credit Union. I liked what I saw here, pretty attractive. All right, okay, they have a home equity loan as usual. Scroll to the HELOC. We got introductory 3.99 for the first 4 months. All right, so just 4 months, but then it's prime minus 0.5%. So I'll be at 6.75, 10-year draw. Simply write checks from your HELOC or online transfer, so we know mobile banking friendly. No closing costs, like that. I like that a lot. Here's what's also very, very interesting. The max is only 13% on their product. It goes as low as 2.75, so if rates do come down, the lowest that your rate would go down is 2.75. Most stop at 4, 3.5. This goes pretty low. So although the intro rate is shorter, the rate itself is lower by about 2% compared to the other options we've shown so far. And then the overall rate is always going to be lower, that prime point minus 5, prime minus a half. No closing costs. I'm not upset about that. See if there's any other information I can find. Nope. First New York Federal Credit Union. This one caught my eye. They've got this 1.99 10-year draw for 13 months. Then 80% LTV, prime, just prime, not bad at all. And that's the only caveat. So we have a $10,000 required at time of closing draw. Not too upset about it. That's small enough. The workaround is if our chunk was less than 10 to start with, let's just say, you can always just deposit the difference right back into the line. So not a big deal. Let's see what else we can learn. So they got two. If you stay below the 80%, you'll be at that 1.9. If you go above, it's 2.9. And it costs you 1%, that little difference. That little difference. So you don't want to make that mistake. They'll cover your closing costs. All right. So at prime, it says 7.5, but that was of December of last year, so they haven't updated it. More than likely, it'll be 7.25 when you get it. So, not upset with this product at all. It's quite attractive. That's a bank that I would be calling if I lived in New York to get more information. Okay. I didn't see if it was mobile banking friendly. That's the only thing I did not see. If they're not mobile banking friendly, that could be a deal breaker. Could be a deal breaker, okay? But again, 1.99 for 13 months, that extra month, pretty attractive. Prime, no closing. I'm not upset. And let's see what happened here. What bank was I looking at? I think it was this one. I got this 3.99 that caught my attention. But it's not going to the site for some reason. So Northern Credit Union is the last bank that I was looking at. Let's see what they got here. They got no annual fees or closing costs. Okay, let's see if it can make it to the whiteboard. Let's see. That's a home equity loan. Home equity line. Uh-oh. So 1.996 months. Okay. Using your debit card. Okay, mobile banking friendly. Okay. It says prime plus or minus a margin based on the amount of the credit line, borrower's credit history, and loan to value. So it looks like it could be a prime minus 0.25% as long as the borrowed amount between 7,500 and 100,000. A plus credit. Let's see if they tell us what A plus credit is. I'm going to assume A plus credit is 720 or higher. And that is 80% LTV. So we need to be in 80% LTV. We need I think this makes it to the whiteboard. I'm not upset. Not upset. So this bank, Northern Credit Union. 5-year draw. Okay. So the 5-year draw is short. Don't love that. But I'm not upset. So again, don't get confused by borrow up to 100%. Stick with the 80. That gets you the best cost. 80 LTV. No closing. Mobile banking. All right, let's go to the board. So this is all the research I've done so far. Mobile banking. 1.99. 6 months, right? Let me make sure. Yeah, 6 months. And then if you have a really good rating, prime minus 0.25%. All right. Let's evaluate. Let's start to narrow down our options here. We New York competing, some pretty competitive stuff so far. Not upset. But municipal credit union, they want too much. So I would cross that out for me. This is if I live in the state of New York, I'm looking for a second lien HELOC. I now want to maximize my time. I don't need to call every single bank here. I can make a decision based off of the facts that they currently gave me. Then I'll call the ones that I like the most. All right. So Broadview, very competitive because they got those two different options: 3.99 for 12 months, 7% afterwards, zero closing costs, or 5.25 fixed for 5 years. I like that a lot. This Hudson Valley, 4.5 for 6, 7.25 with the 0.25 auto pay. Hovia was coming in at prime, 5.99 for 12 months. So technically, I may come out ahead of Hudson in the beginning, but then Hudson would end up ahead over the long run because of that 0.25 difference compared to prime. But they do have a larger credit line. Okay. Now, Advantage was being even more competitive with the prime minus 0.5, 3.99 for 6 months, 10-year draw, no closing costs. So what do you prefer? Do you prefer the lowest intro rate on the board, let's say, with the lowest prime rate afterwards? So far, this bank, Advantage Federal Credit Union, what it has over everybody else is the prime minus 0.5% for the lowest interest rate, lowest intro rate. But it's only 4 months. And you also have that low max rate of 13%. First New York Federal Credit Union was 1.99 for 13%, no closing costs, 90% LTV, prime, just prime. You may really be attracted to this bank because you get the lowest intro rate offer for the highest LTV option, no closing costs, and you just remain at prime. Whatever prime is, that's what it is. You might be perfectly fine with that if you're somebody that's consolidating a lot of credit cards into one place. If you are, consolidating a lot of high interest debt that you really need a lot of relief, First Federal might be, a top pick for you. So Broadview is very attractive for long term. First Federal, very attractive for short term. Advantage Federal Credit Union, although a short intro rate, long term, this is good. Long term. So if you're like thinking more long term, the longevity of all the debts that I'm carrying, Advantage and Broadview are your top picks for long term purposes. Short term, First New York Federal Credit Union, highly attractive. And Hovia is also short term, very attractive. 5.99 for 12, 1.99 for 13. Both are at prime, no closing costs. 80 and 90% LTV, max credit line 500K. We don't know what the max credit line is for New York Federal Credit Union. You can find that out. Midterm thinking. You got Hudson. This is midterm. This is like, I'll keep this product for 3 to 5 years, If you're on a 10-year draw, if you're thinking long term, and the way you really start to process these decisions, you have to put your numbers into this. So if you're somebody that has $800,000 of debt, and it's car loans, student loans, personal loans, IRS debt, credit card debt, a mortgage, and I don't know what else, because I probably covered it all. But like if you're someone that has the whole nine, like you have every kind of debt there is, ideally you want to look with the lens of a long-term bank that may be offering the best rates for you, the best overall option. Broadview and Advantage are going to be very attractive for you. If you're carrying 200,000, 150,000 of debt, you may be a little more inclined towards the shorter term offers that are more attractive. 1.99 for 13 months. You're like, in 13 months doing velocity banking, I could wipe out a third of my debt. You might want this. It would be like, no, take this for you, because you don't have as much debt as the person that's sitting on 800 grand. Plus, you could always graduate. Remember, we're not married. You could be with First New York Federal for 2-3 years and then bounce, jump to Broadview, lock in another 12 months, or get a fixed year rate, because they might change it throughout the year. This might go down. Okay. This was also the short term, right? 5.99 for 12. Midterm. This is like getting into like a balance of both short and long, where it's like you're gonna be below prime, which is attractive. Anything below prime is always attractive, even if it's just 0.25. That's still attractive. 4.5% for 6 months and no closing costs, mobile banking friendly. I'm not upset. Northern Credit Union was kind of the same thing, but the difference was the draw period is only 5 years. No closing, but 1.99 for 6, and then prime minus 0.25. So technically, from a rate perspective, Northern is better than Hudson. Same intro rate period, but lower rate, 1.99 versus 4.5. And then I'm at a prime minus 0.25, just like them, prime minus 0.25. I think the LTV was the same, 80%, if I'm not mistaken. So Northern is better than Hudson from a mid-term perspective. I'm not, upset about that. Out of the both short terms, New York Federal is more attractive just from the interest rate, intro, period, and the LTV option. Long term, who was more attractive? That's a tough one. If you set aside the fixed rate with Broadview, then Advantage is technically ahead. 3.99 for 12, only 3.99 for 4, but they make up for it with prime minus 0.5 with a max rate of only 13%. 3.99 for 12, 0.25 discount, prime minus 0.25, right? As low as 7%, 90% LTV. But if you throw in that fixed rate, if you want the fixed rate option, you're thinking long term, Broadview is better. So Broadview is like number one out of First Federal and Hudson. It was First New York, more attractive. Short term and short term. Out of First New York Federal and Hovia, we like First. Out of Northern and Hudson, we like Northern because of that 1.99 for 6, and then equal on the prime minus 0.25. Hope this helps. where it's like you process all of this. All right. Let me take a look at some questions. Okay, let's see if I see anything interesting going on. Yep, doing well, thank you. Would you consider a no cash advance fee? Would you consider a no cash advance fee credit card a PLOC? No, a credit card is a credit card, a PLOC is a PLOC. Now, what I say is there are credit cards that function like a personal line of credit where there's no cost to turn credit into cash. If there's no cost to turn a credit card that you have in your portfolio and you can transfer money out of there via convenience checks, balance transfers, or cash advances to a checking account, then that is functioning like a PLOC, but I still respect that that's still a credit card because look at the interest rate on it. Compared to a PLOC, often the PLOC is at a lesser interest rate than a credit card, okay? And then I asked because it allows you to revolve debt with no fee. It has no grace period, much like a PLOC. Correct. So when you cash advance, although there's no fee, you are accumulating interest like instantly that you'll have to cover, if I'm not mistaken. So the cost of doing velocity banking with a credit card is typically always going to be higher than a personal line of credit. But here's the good news. You don't have to compete. You could have a credit card and you can have a PLOC. And you get the best of both worlds. So for me, I like to park all my income into the PLOC, use the credit card for the grace period of running all my bills that can be paid with a credit card, get the points, get the cash back rewards, get that grace period, then pull from the PLOC to pay the credit card on time and full or the statement balance, and then keep rinsing and repeating. I'm paying far less in interest costs on the PLOC than if I do a cash advance at 25% on that credit card or 18% or whatever it is. Good stuff. Yeah, up to 1.5 million on a HELOC is amazing. Not sure if I believe it though. No, it's real. There definitely are banks that go that high. I've got clients with some pretty large HELOCs. Look up Clover if you haven't already. They were Bethpage Credit Union. Okay. Clover. And then we're done. Okay. Clover Credit Union. Let's see what pops up. Clover Belt, maybe? $10 to $100. 10-year draw. They're not giving too much information, so they can't make it on the board. Home Freedom. Home Equity. Home Equity Flexity. Home Flexity. Home Equity. Oh, yeah, you got a call. Okay, so they're not giving information there. This might be referring to their home equity loan, so don't get confused. They're not going to make it on the board. Let's look up Bethpage. So now they're called 4-leaf. Is that why this came up? So now they're called 4-leaf. So I've had a bunch of clients use Bethpage in the past. 7.25, 6.49 for 12 months intro, lines up to 500. No closing. Application fees. Interest only. 10-year draw. I mean, we could as like another option, but the banks I've shared are a little more attractive because of the rates. They're all lower. All the rates that I found are lower than 4-leaf. So I mean, like, it is an option. Let's not, just throw them out the door. They are an option. They're just not going to make it on the whiteboard just because of all the intro rates that I have on my board are just more attractive and longer, right? 5.9, 3.9, 1.9. So good stuff. We're done. Now, action steps. Again, if you want to work with me one-to-one, I'm doing a promo every time I go live. I'm offering my lifetime coaching program, $600 off the total price if you pay in full. If you need to make payments, you just reach out to me, email, we'll figure that out. But I'm incentivizing those that pay in full. If you've done work with me in the past and you want to pick up where you left off, now's an opportunity. I'm only taking on a few more families before the year is over. And stay tuned, because your state will most likely be next. Okay, we've already done a few so far. Sometimes I'll do 2 in one video. So make sure you look through it all. I'm going to create a nice little playlist and continue to serve you at the highest level, okay? God bless you. Enjoy the rest of your day, and we'll be talking soon. Bye now.